Wow, what an interesting talk about human work in progress. I was really sitting there and wondering what's the connection to corporates working with startups, and I figured that this is an area which is also work in progress anywhere in Europe, but above all here in Poland. My name is Ewa Treitz. I've worked in venture capital and corporate venture capital for the past 8 years. And I've done investments for institutional investors and corporate investors in Scandinavia, Germany, and in the US. And I'm so happy that I have the honor now to present here at Infoshare and go back to my home city, Gdańsk, and help out a Polish venture fund, Black Pearls, out of Gdańsk, also to drive forward these activities in corporate venturing here in Poland. Corporate venturing is really a flagship topic in most of the Western European and US economies. As I said, it's becoming really a very important topic here in Poland as well. And to just illustrate why this is so and why it's so important for corporates, I will start with a little story. In 2007, a company each of us knows, Nokia, acquired a company called Navtech for over $8 billion. With that acquisition, they wrote on their website, Nokia wrote on the website that it's a highly strategic acquisition. It will bring Nokia leadership worldwide in automotive GPS systems, and it will make Nokia long-term competitive in the market. With that acquisition, Nokia acquired a lot of assets as well, infrastructure assets, towers, communication antennas, and so on. The same year, 2007, two other important things happened. Number one, the first mass-market smartphone was launched in Western economies, iPhone, and a small company just got founded in Israel called Waze. How is that connected? A couple of years later, Waze, that speculated on the fact that each of us will, in a couple of years, own a smartphone which has GPS device in it, it speculated that you can use that smartphone to basically give traffic information the same way a Navtech system is providing to the users. And they were correct. 2013, Waze got acquired by Google, as you know, for over $1 billion. And well, the story of Nokia, you know that story. There are other areas. You can see some examples over here where innovation happened really fast within a very short period of time, just as much as it happened in GPS traffic solutions. And a lot of corporates are realizing that because innovation is happening so fast, there's no way that they can develop so fast within their R&D facilities. The solution is to go outside of the R&D facility, to go to the startup community, to go to other companies and look what people are developing outside of the factory gate. It's interesting that a lot of companies that used to be Fortune 500 companies not such a long time ago aren't anymore. So the world is moving faster, and it's just in the interest of corporates as well to look more and more into this startup world. An answer to that in many economies in Western Europe and in the US has been to set up so-called corporate venturing units. Just to give you a very short explanation what corporate venturing is, it's basically an organization within a corporate organization that invests in startups and wants to basically find out what is happening in the markets that the corporate is addressing in the startup community. And quite often these collaborations with startups, they are coupled with equity, which is invested from the corporate into the startup, and then there's some collaboration project between two parties. This entire sector of corporate venturing has really exploded in the past 10 years. We have more than 1,200 corporate venturing units worldwide. Most of them are in the US and Western Europe, but as I said, there's more and more interest now also in Poland and Central Eastern Europe to drive the same kind of activities here. And the question, I guess, is pretty clear why corporates want to work with startups. It's because they want to get a glimpse of what's happening in the outside world in the areas that are of relevance to them. Last year, around the same time, I made a study and I asked 100 entrepreneurs, mostly from the US and Western Europe, about their motivations to work with corporates. And the answer was that obviously the reason they want to work with corporates is because they hope they're going to get market access, they're going to get money, and they're going to get brand behind their back. Interestingly enough, you can look at that study. It's published on my LinkedIn profile. Interestingly enough, the result was actually that mostly what startups got from this collaboration is technical support. What does it say? It says that once you go into a collaboration with a big corporate, as a small startup, you really need to know your tricks. You want to know what you need to do, how you need to play with corporates, and this is what I want to give you some advice on today from my experience in corporate venturing for the past couple of years. So, number one, timing is essential when working with corporates. There is this trend now in Silicon Valley, also now in Europe, that you as a startup should approach your potential clients super early on. If you can, you should probably approach them with an idea already to get some feedback. Well, the truth is that if you're approaching really big organizations, at that stage, you're probably going to get no feedback, or you're going to end up working on tailored consulting projects with corporates. So the piece of advice I want to give you is that the best time for you to go to corporates, if you're a startup, is right before you actually start commercializing your product and right after you developed a fully functional prototype. This is the right time because then you have some leverage power. You can actually describe what you want to do, you can present some hypothesis of what your product is going to be, and then you get some feedback. If you go too early, as I said, there might be a risk that they want you to develop a tailored product for them, or they want some special rights like exclusivities that you're not able to give. If you go too late, after the product has been fully commercial, you might maybe miss some feedback from the corporate, which could be interesting. Especially for companies like 3M, BASF, very IP-driven companies, it's quite important that you don't go too early, because then you can lose maybe some exclusivity right. Okay, speaking of exclusivities, this is the advice number 2. Don't cooperate with big companies at any cost. And what I want you to take away from that is really consider the ways to go around giving exclusivities on your core technology, core application, and core design. And it might sound pretty obvious, but I've seen a lot of companies actually being desperate for cash, giving away some of that to the corporates. It's really important to know that there's ways to go around that, so you don't necessarily need to give away core technology or core application, but there's free mechanisms that you can use to basically still give away something special to the corporate if you have to, but that wouldn't ruin your chances to commercialize with somebody else. Number 1 is that you can limit the time for which you give exclusivity. So for instance, at 3M, where I used to manage the European investment operation for the last 4 years, you can you basically negotiated 36 months of exclusivity, up to 36 months during the technology development time. Usually for companies that are a bit more advanced, it was much shorter, so it was below 12 months of technological development. And then after the product has been launched, we had up to 6 months of exclusivity in the market. And for a startup, it was acceptable because 6 months is not really a very long time for an IP type of company. And for us, it gave us just a bit of a head start ahead of other competitors in the space. So number one, you can basically limit the time for which you give exclusivity. Number two, you can consider giving exclusivity for maybe an area which is not your core area. So let's say you develop a new material, a carbon fiber material for airplanes or cars, and somebody comes along and would like to take an exclusivity for producing bikes with your material. You could go ahead and probably give some exclusivities in the adjacent areas, but still keep the core to yourself. And number three, which is kind of related, is give exclusivity on a specific setup, which where your system is embedded. So let's say you developed a system on a chipset, which goes into a measurement device for the quality of electricity. You could maybe give an exclusivity for a setup in a distribution transformer. So a very specific setup where your system is embedded, but you still keep the right to market the technology standalone somewhere else. So timing, time period, application, and setup in a system could be some ways to go around giving exclusivity. Now, I've been at venture funds and I've been at corporations, and I can tell you there's a lot of people at corporations that are very bored with their jobs, and they just love working with startups. Quite often these people are somewhere around lower mid-management level. A lot of engineers that are very interested to work with startup, but they basically don't have any decision power of whether your project is going to go up or not in the priority list. I just warn you to be aware of people like that. They're very engaged people, and you can have a lot of very productive technical debate with them. But at the end of the day, you need to make sure that sooner or later, and preferably sooner, you get to people that actually have budget responsibility. So people that in the US corporate system are somewhere around vice president, executive president level. And usually you don't get to these people directly unless you have excellent connections. You get to these people through mid-management, so through senior managers like myself at 3M, or directors that can influence and champion your company to the top upper management. And these champions, really, these are your most important people. These people need to get to know about you early on. And then two more pieces of advice. One is about allocating budget internally at corporation. So of course, the first priority for you is if you want to work with corporate and maybe you want to have an investment from a corporate, is to secure that money for your own company. But once you've done that, that doesn't mean that the project is going to succeed, because quite often internally at corporate, there is some budget decisions that make it impossible for people that work with you to continue the project. So try to find out early whether there is also budget allocated internally at corporation for your specific project. And work very closely, as closely as you can, with your champion on that to try to find out how many months, how many more months, and how many full-time equivalents, how many people basically you have on the project for how long. This chart that you see on the slide is also from the study that I mentioned earlier that I performed last year. And basically what it says is that you have to start a project with a corporation at the time of investment, if you get an investment from a corporation, or within 6 months of that investment. Otherwise, it's very unlikely that you're ever going to be starting a project. So it kind of becomes an old story, if you will, at some point, and it's very hard if you've been working with a corporate to then start working a long time after the company invested in you. And then the last piece of advice, I know this one is very relevant for US kind of operations, and I know that it's important also in Western Europe. I think this is only coming now to Poland, but there's some investment terms to really watch out for when you work with corporations that I just want to make you wary about. And these are the 4 terms that you can see now on the slide. The first one is right of first refusal, and call option are basically 2 rights which limit the way you can exit the company and where you can exit your company to. Right of first refusal basically means if you got an investment from Siemens and you get an offer from Bosch that wants to acquire a company for 100 million. You have to go to Siemens and you need to inform Siemens that Bosch is giving 100 million, and then Siemens has some pretty long time usually to consider maybe giving a counteroffer. Why is this dangerous? It's very dangerous because it basically means that Bosch, knowing that you have this term in your investment agreement, will never go into due diligence to look at your company, because they know that they might spend 6 months looking into your company, doing all the due diligence, giving you an offer, and then in the end, you know, Siemens might come along and give just €1 more and acquire a company. So a good alternative for that term, which has been now adopted anywhere I know in the US and Western Europe, is to give so-called right of first offer, which basically means if Siemens invests in you and you get an offer from Bosch, you tell Siemens and they have 7 days to consider giving you an offer, have an exclusive time in which they do due diligence, but you don't need to take the offer. So all they get is just these 7 days in which they are the only ones that can look at your company and give you an offer. Call option works the same way. It basically predefines at what price your company is going to be sold, at what time to your investor. Usually it's a multiple of your revenues or your EBITDA. And it's even worse than right of first refusal because obviously it limits how you can sell your company. And then the last 2 are really about board governance. So if you have a term which is, for instance, giving a board seat to your investor that is a strategic investor like Siemens, they could, of course, have conflict of interest, even though they represent your company officially. So a good way to go around that is to give a board observer seat, and that board observer will need to be excused from board meetings if a strategic discussion about acquisition is taking place. And then the last one is really just a work of numbers. So if you have a corporation which has a majority which might be blocking your decisions in the board of directors, so let's say you need 75% of the board members of the shares to sell a company, and Siemens is holding 26%, then you really might have an issue there because they can block the transaction. So these are just the things that you should be familiar with if you're negotiating a contract. Honestly, with any venture capital investor, but also especially with corporate venture investors, because those really can have a very impactful effect strategically on the direction of your company. So just to sum it up, I think it's very important if you start working with corporations, which really, of course, brings a lot of positive things, which I haven't talked about because these are the things that you're going to hear from corporations that want to work with you anyway. I mostly focus on things to watch out for when you start working with corporations. I think from my perspective, my experience, you should not be going way too early into a collaboration with corporation because you simply have no leverage yet. So you have to have some kind of a product idea, prototype, and preferably some kind of a proprietary right before you go to a corporation. Try not to work with corporations at any cost. So don't give out exclusivities for your core areas or your core applications, and try to limit any exclusivities with regard to time, no longer than, let's say, 24 months. Try to get to the right people. Try to avoid people that simply might just waste your time in the long term, even though they're wonderful people to work with. And then make sure that there's some budget allocated also for your project internally at corporation, because in the end, this is going to make or break whether you actually can work with the team at corporation or not. And then there's some investment terms that you should watch out for, which you do not want to have in your investment agreement if you want to have a sustainably growing startup. All right. So I hope that was useful. It's exciting to see that there's now an increased interest for corporate venturing, both from private Polish companies, but also from the state-owned Polish companies. They obviously see the need that you need to look for innovations from outside of the company. And I'm very happy that I can share my experiences in that space from my work at 3M and venture funds in the US. Thank you so much.
Thank you, Eva, but you cannot go yet because we still have questions. I already heard some burning questions because thanks a lot for your insight. And it is very useful, of course, from the moment that you are in touch with a corporate or when you are a corporate with a startup. There are some startups here, and I already heard them saying, but okay, how do I get in touch with them once I have that MVP ready? Where will I find them? Do you have tips on that?
Of course, yeah. There's a couple of ways to go in touch with corporations. In Western Europe or in the US, corporations usually come into the companies a bit later than traditional venture capital funds. So of course, one of the ways is really when you get a venture capital investor to look out whether these people have connections in corporations, and quite often they do. And this is really the value add that a lot of investors offer, that they will make you intros. At the end of the day, it's really a people's business, so you need to try to find your way into this champion somewhere in the company, and it quite often might start from below. So you might maybe meet a senior engineer, but then try to really make them excited about your company and your perspectives of your company, and try to get as soon as you can into this champion level in the corporation. And of course, events like this are helpful, although I think they're helpful only really to show faces and have a chit-chat, but in the end, you have to have this face-to-face, one-to-one meeting facilitated by somebody.
So get out of the building and talk to your potential client. That's probably the main advice. Any questions in the...
There's a question there.
Hi.
Hi.
Hi, can you hear me? Okay.
Yes.
Hi, I'm here.
On
the right, on the left of yours. Thank you so much for sharing the information on the clauses. I'm an investor myself, so I actually tend to put on these clauses into the term sheets, etc. So would you share what clauses are you actually putting from the investor point of view that you find reasonable? So which one that would actually also take into consideration the interests of investor, but the one that you find fair, simply?
Sure. I mean, I'm not going to go through the long list of a lot of clauses, but I always put preferred shares, so liquidation preference as an investor, and that's very powerful because in the end it gives you, if you exit, the first money out. I always get the board seat. So for an independent VC investor, it's not an issue to get a board seat. It is an issue if you're a strategic investor because you can have a conflict of interest. And then, of course, influence on the decisions that are made in the board. So you want to have a stake which is big enough if you want to influence certain decisions. But these are really the important ones. And then there's lots of smaller things, obviously. But really, the decisive majority vote and board seat and preference, these are the important ones, in my opinion. And then pro rata participation if there is a next round.
Anyone else? If no, then we thank Eva once again.
Thank you.
Eva.